Hi there, welcome to Kneppy Invest. For those who celebrate December 25, Merry Christmas. For those who don't celebrate this day, happy normal day of the year. For me, this day falls more into that second group. In fact, I won't see a single person today, and that is absolutely okay with me. I'm fine being by myself for an extended period of time, so don't feel sorry for me. This is something I actually do prefer. If I'm not working on December 25, I prefer just to stay home, maybe watch some TV, some movies, because there's no sport today, which is another bummer. No ASX Open as well. So I'm happy being by myself. I have my dogs here, and that's all I need. But I thought I'd have some fun with today's video, and it all comes back to what happened just after midnight this morning. I heard a bit of a ruckus downstairs, and I had to explore what was causing that ruckus. And who did I find in front of my computer? Well, it was no other than Santa Claus. He looked a little bit different than our images we usually get of Santa Claus. He did have that beard. He was dressed in red, but he was not quite as plump as what you might imagine. But as we got to talking about what he was doing in front of my computer, trying to hack his way into my trading account, he became pretty open about his expectations, and he's thinking of changing it up. And I asked him, what does he mean by changing up? Well, he said that ever since he started delivering presents or giving presents to kids, he's come to the realization that present giving is usually a very short-term hit. So when you receive a present, you have this short-term sugary sort of hit that usually doesn't last very long. And a lot of times he's just giving the latest fad to kids, and he's thinking, what if he changes up? What if he gives presents that have a lasting long-term impact? And he's thinking about, what if he gives investments as presents? And I was thinking, what a great idea. And I told him, potentially the best present he could give is $5,000 worth of investments when a child is born. And the reason behind that will become obviously clear, because if you do that, or if he did that, he would set that child up for life if he could invest at 20% per annum. And how much would that child be set up? Well, let's have a look at the power of compounding. Now, of course, Santa Claus is not real, but you know what is real? Compounding. It's one of the most real things out there. And in my opinion, one of the most important subjects that should be taught at school, that isn't taught at school, is investing. Because the earlier you can get someone to get interested in investing, the more better off they will be in the long term. And in my opinion, the greatest gift you can give a newborn baby, apart from life itself, is $5,000 as an investment. And if you can achieve 20% returns per year, which is definitely achievable because many investors throughout history have done this on a consistent basis, you have set up that child for life. So I just went online to a compounding calculator website, and I just put in some numbers. So the initial deposit at $5,000, no regular deposits. That's the other thing here. You're not adding to this investment. It's just $5,000 at birth. And after 50 years with 20% return per year, the end result is $45.5 million. I'll just repeat that. $45.5 million. You have set up this child for life. Back to the fun hypothetical situation where Santa Claus has hacked his way into my trading account and has made some investments, some strategic investments based off things that he thinks I should be investing more in, like ETFs, and companies I might be interested in just based off my general interest. So he bought an ETF, an international company, a turnaround stock, a positive sentiment stock, and a recent IPO. So let's get stuck into it. And the first thing he bought me was an ETF. Santa Claus thinks I should be a little bit more interested in ETFs. He believes it is the way of the future, and he decided to give me the Vanguard Australian Shares Index, VAS. I was quite disappointed with his choice here because this sort of ETF does not interest me at all. 0% interest in the Australian Shares Index ETF because the majority of the holdings in this ETF are the sort of companies I do not want to be holding for the long term. For instance, CBA, BHP, NAB, ANZ, Westpac, Macquarie Group, Wesfarmers, Woolworths, Telstra, and CSL. About 8 or 9 of those companies are the sort of companies I'd probably only own for the short term or when the share price really pulls back a fair bit. Sort of companies in that group where I might own for the longer term, CSL, Macquarie Group, even Wesfarmers, only a small percentage overall of the largest holdings within the Vanguard Australian Shares Index. So this sort of index is not for me. So I told that to Santa Claus and he said, well, maybe you can just sell this and buy a comparable sort of ETF. So I thought about it and I decided upon a very similar Vanguard ETF with only one letter different. And that ETF is the Vanguard MSCI Index International Shares ETF, VGS. And this is buying the biggest companies in the world, very similar to a NASDAQ. So the largest holding in this particular ETF is Apple, second largest is Microsoft, then we have Amazon, Tesla, Alphabet, Nvidia, Facebook, JP Morgan, Home Depot. Seems like they're all US companies. That's the best, about 11 or 12 companies in this particular ETF. So not a lot of diversification in regards to it being an international shares ETF. So I would prefer a little bit more diversification. But over the past 5 to 10 years, you'll be getting way better returns in this ETF compared to the Australian VAS ETF. So let's have a look at the comparable returns in regards to these two ETFs. On the top, I've got the VAS returns year to date, 1 year, 3 year, 5 years, 10 years. Nice returns over the last 10 years, 10% per year, 5 years, just over 10% as well. But if you look at the VGS, over the last 5 years, it's up to 16% per year, 3 years up to 18% per year, and 1 year at 27% per year compared to the VAS, which is at 16% per year. So you do get better returns buying the VGS over the VAS. I would prefer a little bit more diversification in regards to the VGS. I'd like a little bit more international flavour, I suppose you could say. But if I had to choose between the VAS and the VGS right now, definitely go towards the VGS. Santa Claus knew that I was interested in investing in international companies. And the first company he thought of, based off my other sort of more general interest, was LINDT chocolate. I believe this is listed on the Swiss exchange. And I do love Swiss chocolate, particularly LINDT, and particularly those balls they make. And my favorite sort of balls is the sea salt caramel, particularly the dark chocolate balls. I also like the dark chocolate, caramel, and sea salt. But any sort of balls I can get, or LINDT balls I can get, I will devour them. So this was a great present from Santa Claus. I did have a look at the financial situation of this company, and they are growing at a slow rate, so I would prefer that to be a little bit greater. The other thing I do like is the chart. So let's have a look at LINDT chart right now. LINDT share price is in a beautiful uptrend ever since March of this year. Share price has increased from about 86,000 Swiss francs, I think this is in Swiss francs, up to current share price of 122,000. So almost a 50% increase in the share price over the past 10 or so months. But simple fact is the share price is in a real nice uptrend, and hopefully LINDT management at some point in the future will decide any shareholders who keep on to the shares for at least a year will be given free chocolates for the rest of their life. That would be an amazing policy by management, and if they ever did that, I would be definitely becoming a LINDT shareholder, in all seriousness. Santa Claus also knows I'm a massive fan of pizza, one of my favourite foods. So I'd probably have this just below burgers, maybe just above burgers. The only difference between burgers and pizzas is I do actually eat burgers quite regularly, but pizzas I don't. I might go a few months without eating a pizza. But if I am ordering pizza, more than likely you will see me ordering pizza capers. There are a few pizzas at this a business that I do quite enjoy, and Pizza Capers is owned by Retail Food Group, unless it's changed over the past few years. Now, Retail Food Group had been in the news a few years ago, and the share price had been under significant pressure. So I'm not sure if this is a good investment. The other thing is Retail Food Group own quite a few cafe sort of businesses, coffee businesses, and I'm not a fan of coffee. I, in fact, hate coffee. That's one thing you should know about me, is I absolutely hate coffee. Not only the taste, but also the smell of coffee. So let's have a look at the chart to see if there's any good momentum in the share price of this company. And if there's not, maybe I'll trade Retail Food Group in for another company. So looking at the daily chart from the start, well, actually this is a 2-year period, so this is just towards the start of this chart, is just towards the end of 2019. The share price was under considerable pressure because of those shenanigans this company was facing about 2, 3, 4 years ago. But the share price is consolidating and has been consolidating for about 18 months. So we're going through a long consolidation period for this company. And the breakout in the share price could happen at any time. We've seen a couple of potential breakouts over the past year and 3 months, but the last 2 breakouts have failed. You can see back in July, the share price popped up on some good volume, but then pulled back a few weeks later. So that was a failed breakout. And the current share price of Retail Food Group is 6.9 cents. So at this point in time, I told Santa there's no reason I should be holding these shares, even though they do own Pizza Capers. And he said, is there any other company or turnaround company you are thinking about buying right now? And one company did come to mind, and that's the company I thought I would exchange Retail Food Group for. And that company is Clover Corporation. This is actually a company I've owned in the past, about 3 or 4 years ago, when the share price was actually moving up. Then the share price moved into a downtrend, and that downtrend pushed the share price from about $3.25 all the way down to a low of $1.20. But that downtrend was broken at the start of November, and the share price is wanting to move into an uptrend. So there is potential that Clover could be at the start of hopefully a long-term uptrend. So if I had to choose between Retail Food Group and Clover, I've decided to put my money or my present into Clover Corporation. Santa Claus also knows that I'm a sucker for companies that are or have positive sentiment behind the share price and the company itself. And the company or the stock he chose for my present in this category was TUAS. Now, if you don't know who this company is, they were spun off from TPG. They're a very similar company than TPG, but their business is in Singapore, and it's been run by the old TPG CEO David Tuo, or his last name is called. And he was a fabulous CEO of TPG, and I was an investor of that company, and I did very well. And right now, the share price has been on a run ever since August, with it increasing from 65 cents to a current share price of $2.10. So a lot of positive sentiment behind this company right now. I haven't looked too deeply into how they're performing financially, but I decided, because this was a present from Santa Claus and because there is a lot of positive sentiment behind this company, I thought I'll just hang on to these shares for the time being. Santa also knows that I'm becoming more and more interested in researching IPOs because of the opportunities that do exist there, that I'm also a massive fan of animals. I love all types of animals. My favorite animals, apart from my 2 dogs, are polar bears. If I could own a polar bear, I would absolutely do that, even though they would probably absolutely scare me stiff. And one of my dream places to go is any location where I can see a polar bear in the wild. And because I'm interested in IPOs, because I'm interested in animals, Santa thought a company called Mad Paws might be up my alley. I had a quick look at the financial state of this company and the chart, and unfortunately, share price has not really been doing anything over the past 6 months for this company. It's been going sideways And in fact, there is a bit of short-term negative sentiment right now, pushing share price down to 18.5 cents. And we're also seeing the volume draw down or fall down, which means there's less and less interest in this company over the past 3 or 4 months. Had a look at the most recent Appendix 4C. They are operational cash flow negative by over $2 million. So I just thought at this point in time, no, even though I do like animals, I am interested in IPOs. I'll just spend a little bit more time seeing if Mad Paws can become successful in the future, simply because the lack of positive sentiment. I think I would have a little bit of time just because of that. So Santa said to me, well, what recent IPO would you be interested in? And the one company that came to mind was a very, very, very recent IPO, which actually only listed on the ASX a few days before Christmas, and that company is Atturra. I have been actually researching recent IPOs. There's been quite a few. In fact, there's like 4 or 5 on the one day. And I did read something the other day that the abundance of IPOs is another sign of a potential top in the market. Doesn't necessarily mean it is definitely a top in the market, but it's just one of the signs that we're moving towards the top of the market. But Atturra does sound a little bit interesting. It is a tech services business. They've brought up a few businesses into the one business. They were called, before they listed on the ASX, FTS Group, and was founded in 2015. But when I went through their prospectus, and look at the financial numbers, this is where it interests me. So the business itself isn't that interesting, particularly because they are a services business in tech. Sometimes those sort of companies don't have high margins because they have to hire a lot of labor, and companies that hire a lot of labor are probably low on my interest level. But when you look at the growth in revenue for Atturra, increasing from 65 million in financial year 2019 to 127 million expected in financial year 22. They are profitable and cash flow positive. So operational cash flow positive of $16.6 million in financial year 21, expected to be about $10 million in financial year 22. But the other thing is, the market cap of this company a few days after listing was $124 million. Now, the only problem is, typically, I don't buy IPOs within the first 6 months they've listed. I just want to wait for all that hype to just wane away. So this is not the sort of company I would typically invest in. But I thought if Santa Claus is going to give me some investments, maybe this would be a good one. So my first time I would bought into a company that's just really recently IPO'd. One of the main reasons I love doing videos on this channel is to share ideas with you. So hopefully you've garnered some ideas from watching this video, and the next step is to do further research on those ideas. So if you have any questions about any of the companies I've featured in this video, I'd love to hear your thoughts, your questions, your opinions on any of these companies. The last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.